The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and I know you must think, who the heck wants to hear about taxes? But we're going to get you ready for next year, and we're going to get you ready with your finances. And so this is the time of year we kind of kick out of the tax season mode into like how to get ready for next year. We're going to answer all of your questions. If you got any problems, if you're getting love letters from the IRS, this is where you get all your free tax help. I'm Esther Gulius, the Tax Lady. I'm going to tell you, I just apologize to any of the 4,000 people we served the last 3 days of tax season because it was a zoo. And it wasn't our finest hour. I mean, there was just so many people, but we got through it. We got through it. And that's Tiffany Fabian,
yeah, and I wanted,
our Vice President of Corporate Development.
I wanted to also say, you said that now we're going to change tunes a little bit, and we have some guest speakers on the next few weeks.
Right,
we have Dennis Kitchen, and then we have
Dennis Kitchen's going to talk about bankruptcy, and that's really important because if you're somebody that doesn't have a handle on your finances and you think that you have to pay down that debt, I mean, you want to pay down the debt, but if you can't pay down the debt, realistically looking at it, bankruptcy may be an answer for you, and that's one of our guest speakers.
And then embezzlement specialist.
Right, we're going to talk to John Dosher, who is an assistant district attorney in the city of Buffalo, who really is going to talk about how not to get caught in the fraud. And I'm going to tell you, this weekend, at our own office, we had somebody call who said that they were from American Express and they wanted all of our information, and we said, "Oh no, this is scamming." I mean, it is really scary.
But the bookkeeper was led astray. Right. I mean, they were very talented.
Well, that's what happens. These scam artists, they sound legitimate.
Right.
So you have to be very careful. So John Dosher is going to help us to talk about how to make sure you're embezzlement proof.
Right. Like-kind exchange, gentlemen. Not
right.
Steve Kervin.
So if you're somebody that wants to exchange your property, you got rental property, maybe you want to get out of Buffalo and you want to go to Florida, we're going to show you how to get out of your rental property without paying any taxes.
And then we'll have an attorney on who's going to talk about estate planning.
So, and kind of in that line, we want to talk about, you know, a lot of people have questions about estate planning, and that's kind of what our message is today about how to estate plan. Should you gift your house? If you gift your house, should you put money in a trust and things of that nature? And if you have any questions about that kind of stuff, 803-0930, 803-0930, star 930 on a cell phone. In the meantime, if you're getting letters from the state of New York or IRS, what do? The first thing you do is you don't pay the bill.
Very true. I can't tell you. I've been doing this for 16 or 17 years, and I would say 8-9 times out of 10 they're not right or they're not correct 100%.
In other words, they might be partially right.
Right.
But just because they send you a bill, don't pay the bill. Come to CEG Tax. We're going to look at it. We're going to tell you what to do, and there's no charge for the service because we're in your corner. So if you're getting a bill, don't pay the bill.
Yeah, I had a lady this week, and she was denied earned income credit from New York, and you've heard this over and over again because she said the New York said the kids weren't of age, but her kids are permanently and totally disabled. So we wrote a letter and
showed that they were disabled. Yeah. New York State automatically just disallows children that are over the age of 23.
Yeah.
And that doesn't mean you're wrong. It means that the state is basically saying, oh, prove it to us. And that's no problem. We'll prove it to you.
Right. Correct.
Right? So 803-0930, 803-0930, star 930 on a cell phone. And we got Jim in Tonawanda. Hey, Jim, how you doing?
Oh, pretty good. So I want to make my brokerage account a joint account with my son for convenience purposes.
Uh-huh.
My wife and I were incapacitated. He's going to have to pay our bills. Now, the account's in excess of $50,000. The dividends, interest, and capital gains will still go to my Social Security number.
Right.
Now, will the IRS consider this a gift or half a gift?
Yeah. If you put his name on, it's a half a gift. And so if it's worth $50,000, you've given him $25,000. So you have to file a gift tax return. Now you won't owe, unless your estate is over $5.34 million, you're not going to owe any gift taxes, but you still have to do the gift tax return.
A gift tax return is sort of like an accounting form, so they can keep track of how much you gifted to each person.
Yeah, because
for
let's
your
say
life.
right now you say, I'll never have a $5 million estate. Well, maybe 3 years from now, they say, well, you pay estate taxes if it's $1 million. So that's where that accounting is so important, because should they drop the estate exclusion, then at some point in time it may be taxable. So you do this gift tax return, which keeps track of all the money you've given away. But yes, if you make your son a co-owner, then he owns half.
Okay. What's the number of that form?
Gift tax return is not a 982. It's I will find it soon and let you know.
Okay, I'll find it online.
I'm going to buzz in soon and let you know.
Okay, Jim?
Okay, thank you.
Thank you, sir. I'm Esther Gulius, the tax lady, 803-0930, 803-0930, star 930 on the cell phone. And we're kind of talking about estate planning. The first thing that a lot of people are concerned about is, especially as we get older, we're worried about nursing home expenses. So many times people say, maybe I should gift my home to my child. And if you do gift your home to your child,
It's Form 709.
yeah,
Form 709 for Jim for the gift tax.
right, the gift tax return. So if you do gift your house to your child, what happens is what you paid for your house becomes what when your child sells the house, what their basis is, and so your child ends up with a capital gain. But you see, everything is yin-yang, risk and reward. The bottom line is, if you don't gift the house to your child and you go into a nursing home, then the nursing home could take the entire asset. So even though the child might owe $5,000 or $6,000 or $7,000 later, after they sell the house, they won't lose the house, which
Right.
might be worth $80,000 or $90,000.
Because you're talking about the 5-year look back, and so the nursing home, they have the ability to look back, or Medicaid, Medicare, to see what you did with the assets. And then Chris taught me something interesting. I learn something every day. Is when you make a trust or estate, and I know we're going to talk about this soon, you put the items in it. There's a 5-year look back, but you can't keep on adding things to it.
Everything is added
that clock
individually.
Starts
Right.
every time. Yep,
Right.
Yep.
I'm Esther Gulius, the tax lady, 803-0930, 803-0930, star 930 on cell phone. I just want to thank every one of you who are our clients. We're so thrilled to serve you. And again, if any of you have any questions, get any bills from the IRS, adjusted refunds, don't panic. That's the way they do things anymore. And EG Tax is there to help you. And we're going to take a short break. We'll be back on the other side with your questions.
I wanted to mention will help.
I know this song. This is the Stones. Stop me up. Stop me up. Stop me up. Actually, Tyler helped me to get my tickets early last week. I'm going to the Stones concert, and I'm so excited because, because I'm old.
I'm very excited too.
And I just want to see them people perform without falling
They
over.
are amazing. When they're on stage, you would think that they're half their age.
Right, you would think so. Maybe
Yeah.
the cocaine helps, you think?
They say it perks you up a little.
I know. I'm Esther Gulius, the tax lady, 803-0930, 803-0930. We want to hear what you have to say. Were you one of those last-minute filers? I mean, we had them standing in the lobby.
It was
I
standing
felt
room
so
only.
bad for those people that were waiting, but my gosh,
I can only imagine that the weather was a big culprit.
It
Yeah.
was. I mean, here you have people that, like seniors,
Right.
that would normally come out in March. They couldn't come out in
That's
March
right.
because there was still snow in March.
Right.
Then you have the late 1099s, the late dividends and interest coming. That stopped up. Then the normal late people.
Right.
So you had whoa. It was,
People would tell me, they'd come into my office and they said, I really don't want to come into your office. It was very exciting in the waiting room. I
was.
mean, there was a lot of
People-
activity.
It was fun.
It was.
fun.
Yeah.
It was fun. Anyway. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. Make sure that if you, now because this is when the IRS is processing all those returns, and if they adjust your refund, you don't get as much as you thought you were going to get. If they're sending you a letter, don't panic. Just call EG Tax. We're open 9 to 5 Monday through Friday. We only have one office open this time of year. That's our corporate headquarters at 2475 Niagara Falls Boulevard. But we're there 9 to 5. And the phone number there is 632-7886. And Auntie Esther answers all of your questions. So if you go to egtax.com and if you have a question, I will personally answer your question.
Yeah, and I also wanted to chime in and put out there that health insurance is really important.
Big thing.
The penalty when we filed your 14 was 1% of your income. Now it's going up to 2%. And we have a healthcare navigator who works for us, and so we'll help you sign up for health insurance free of charge. And
because we don't want you make $100,000, you pay a $2,000 penalty. That's a big thing.
That's a big thing.
And I know a lot of people fundamentally are opposed to Obamacare. Hey, I don't like it either, but I don't want you to pay the $2,000 in penalties, right? Or then, whatever it is.
Yeah, and then also yesterday I did a return for a single guy who made about $45,000. But he couldn't afford health insurance because of this is a whole mess of reasons. And so his mother died. And so I did an exception. To penalty, and we did an application and put her death certificate. I just went and Googled her death, her obituary. You just need a paper proof. And so we sent it in. And
to get rid of the penalty.
Right. So if you got the penalty, you might want to think about amending your return.
Amending your return and see if you get. And again, EG Tax is very happy to help you. Okay, so normally when we are doing emails, we don't accept phone calls. But today we will. But we have because we want to hone in on estate planning, gifting, and things of that nature. So Tiffany, we have some emails here. Why don't you do the first one for Matt?
It says, EG Tax, I was shocked this year when I did my tax return, and I couldn't take the loss on my rental anymore since my income was $150,000. My kids are in college, and I need the write-off. Are there any suggestions? Maybe a trust, he said.
Okay, so the first thing is, maybe people aren't aware of this, but once your income hits $150,000, you're not allowed to take any losses anymore from rentals. And even if your rentals are flat, in other words, all the income are cover all your expenses, when you take the depreciation, it makes you have a loss.
Right.
Which then is a loss against other income and saves you money.
Right.
Once you get to 150, you can't take the loss anymore.
Right. They become suspended losses or rainy day losses.
That's right.
Right.
So putting it in a trust is not going to help because the trust, if it's a trust and he's a beneficiary of the trust, it's going to come back over to the personal return. And again, it won't be deductible because it was over 150. Or if the trust is paying its own taxes, there's a loss and it won't help him at all. So the only thing I can suggest for you, Matt, is that you want to make sure that you've loaded up your pension plan, you and your wife's pension plan at work, that you have completely put in the maximum elective deferrals. If you got that extra income, put as much as you can into your elective deferral so you don't have that much taxable income on your tax return. And so remember, when the money goes to the IRS, it's gone.
Yep.
It's gone.
And another sad point with Matt is he's losing the college credit, too, for his son, because if you make too much money, the AOTC or lifetime credits are gone. You might want to try, if you're getting lifetime, the adjustment to income, but just, as Esther says, load up your pensions.
Load up your, it's, and I had a conversation with somebody in a similar situation yesterday about the same thing, and I said, well, you could always get a divorce. And he said, I don't want to get a divorce. But,
Right.
I mean, if you're putting your income together, and married filing separate isn't going to help either. So there comes a place where if you're making too much money, there is very little that you can do.
Yeah. When you do married filing separate, they also suspend those losses for
Right.
a rental. They put them away, and they don't allow you
So
to do it.
I would say the best thing that Matt can do is put as much as possible into he and his wife's pension plan to reduce their overall taxable income. And really, if his kids are in college, he might want to think about having them claim the AOTC if they're self-supporting or partially self-supporting.
Yeah. I think you told me you were with a client the other day, and they were talking about trust, and you said look at the tax rate for the trust and look at your tax rate on your personal return. If you think you're paying a lot of tax rate on your individual return, let me tell you, boy.
Well, and that's a really good thing. Now, if you put money into a trust, that means that there's a revocable and an irrevocable trust. If you're in a revocable trust, then it doesn't make any difference. It just comes over to your personal return because that means that you can change it. You still have complete control of it. But if you put it in an irrevocable trust, that means that money belongs to the trust. You have given it away.
Right.
The tax rate on a trust on the first $2,500 of taxable income is 15%. The next level up to 5,800 is 25%. The next level up to 8,900 is 28%. Then the next level up to 12,150 is 33, and over 12,151 is 39.6. So you think about how little income that is.
Wow.
And you're putting money in a trust and you're paying it at the maximum rate?
That's very expensive.
That's not a good thing.
Right.
Not a good thing at all.
And very eye-opening when you were telling that guy.
Yeah,
you know?
I mean, so you say, so you're in the this particular gentleman, I said, well, you're in the 15% bracket. If you put it in the trust, you'll pay 39.6%. That's doubling your tax liability. So you got to be really careful when you're talking. It sounds exotic that you're putting money into a trust, but be careful. You got to make sure that it's the bottom line you care about. You want to make sure that what you're doing is accomplishing the goals that you wanted to do.
Right. So ask somebody, call somebody, and find out.
I'm Esther Golias, the tax lady, 803-0930, 803-0930, star 930 on a cell phone. Or we got another question here, Tiff. What is it?
We got Lillian from Fredonia. It says, Tax Lady, my mom gave my sister and I her home about 5 years ago. She is now in a nursing home, and we are going to sell it. It was worth $125,000 when she gave it to us, and we think it's worth around $130,000. So there's not much gain, right?
Is that right, Tiff?
No, unfortunately, when you are gifted something, it reverts back to that original basis. So whatever Lillian
Of the donor.
Of the donor. So whatever mom paid for the house, that's what your basis is. So essentially on paper right now your gain would probably be very extensive.
Yeah, so let's put it in just normal lingo. So if mom paid $25,000 for the house and put $25,000 in improvements, then she's got a $50,000 basis. If you and your sister sell it for $130,000 and you have expensive sale of, let's say, $8,000, then in essence you're selling for like $122,000 from $50,000,
right.
So you're going to have a $72,000 gain.
Right, and that's why.
And so it's not the fair market value at the date she gave it to you. It goes all the way back to the donor's basis.
That's right, and that comes to estate planning. You want to make a complete and accurate inventory of all the assets and their values while your mom is able to
and that's so important. So let's say moms and dads, you're saying, I just don't want the nursing home to get my assets. So it's kind of a yin-yang situation. It's risk and reward. If you give your children the house now, when your child sells the house, they're going to pay income taxes. However, if you don't give it to them and you go into a nursing home, then the nursing home can take the asset. So if the asset's worth $150,000, you don't want to lose $150,000. The taxes they might pay might be $20,000 or $30,000, but it's a lot cheaper than paying a nursing home. And quite frankly, if you have a parent that had gifted a house, and let's say unfortunately they're older and they're on their deathbed, you might want to think about gifting back the house to the parent so that they can inherit the house,
right,
as opposed to having it being gifted to them.
Yeah, I just talked to somebody yesterday about that. That's very wise.
I know it sounds so tacky, your parents dying and you say, gee, we have to give this back to mom and dad before they die. But I mean, it's right. Just estate planning,
That's right. That's right. Yep. And it's really important. I can't stress enough, while you can, ask your mom and dad all those improvements and what they did to the house and
That's right.
what they fixed.
So if they're going to give you the house, go back to them and say, what did we pay for the house?
Right.
What did we put in improvements? How much was that driveway? How much was that garage? Oh, we redid the kitchen. How much was that? And if you can get all those original receipts, it's so important, because now is the time when you're doing your estate plan, that you have all those things in order, so at later on when you're not here, your kids know what to do. I'm Esther Gulius, the tax lady from EG Tax. We have Pat and Dave holding on the phones. We want your phone calls, 8030930, 8030930, star 930 on a cell phone. We're going to break for the news. We'll see you on the other side. I know that's brown sugar. That's brown sugar. Yeah, that's brown sugar, right? Yeah, Tyler says I'm right. Da-da-da-da. Yeah, I know all the Stones. I'm Esther Gulius, the tax lady from EG Tax, and I'm free. Tax season is over. I'm done for 9 more months of the heavy kind of stuff, but we are here to help you, because in 9 months we're back knocking on the door, and we want to make sure that you don't do something that's going to shoot yourself in the foot, right? That's our plan.
Right.
Let's talk about, I know we're trying to talk about estate planning. What's some of the things that people should do right now?
Come up with, make a complete and accurate inventory of all your assets and their values. Determine the form of ownership.
Put it someplace so your kids know where it is.
Right. Determine the form of ownership for each asset. I don't.
In other words,
understand.
If you have stock, if it's owned by you and your kid, you want to make sure that some people change ownership and nobody knows. See?
That's not good.
Right. No, it's not good now, but it's good later.
Right. You should verify the beneficiary designations on pension and life insurance.
Make sure that you have a beneficiary on your pensions and life insurance, because if you don't have a beneficiary, that completely changes the way your heirs are going to inherit it. And it just takes a minute for you to add a designation as a beneficiary.
Right.
I mean, these are just things you need to do, right? What else?
Right. Estimate the size of your estate, because I think you were talking about...
If it's over $5 million, you got an estate problem. And so you want to make sure that... and if you and your wife, if it's husband and wife both, second to die, it'd be $10.68 million.
Right. Determine how financial and health decisions will be made in the case of illness or disability.
Right. Your health care proxies.
Right. I think my dad he went to his doctors and they gave him the forms to figure out his health care proxy, and it's just a conversation you want to have, but you don't want to have.
That's right. You're right. Well, it's life, right?
Right. Reevaluate regularly since situations change.
Right. So maybe you liked your kids and they were your heirs, and now you don't like them.
Right.
You don't want them to be your heirs. You know. I mean, things do change. You want to make sure you keep annually. This is a great time of year, right? If you do your tax return, reevaluate your estate, and if you're going to make estate decisions, make sure you talk to somebody and you know what you're doing. Your friends over the backyard fence are not the people you should talk to.
This is true.
All right, and we got Pat from, I don't know where you're from, Pat, but this is Esther Gulius. How can we help you?
Well, I have a question. It's really not an estate question.
Yeah, that's okay.
But, okay. I have an education fund with my grandson's name on it, and it's very
You mean
small.
a 529?
Yes.
Okay.
Yes. And he dropped out of school.
Okay.
So what do I do? Can this money then be put in my granddaughter's name if and when she goes to college?
Yes, you can redesignate that to the next beneficiary, and it's no problem.
Oh, okay. I was scared because I thought maybe I would have to get it out of there while he was in the same year that he was.
No,
in
you
school.
can redesignate a new beneficiary of the education account, and if they use it for education, it's good. You're good to go.
Very good question.
Okay, great. I can add to that then also.
That's
as long
right.
as I can read. Okay, great.
And Pat, did he go to college for a while, for a year?
He went from September to December.
Yeah.
But the other thing is, Pat, you'd be surprised. Sometimes as they age, they start to realize that higher education is important.
Well, I think he's realizing that as he's on job number 3.
Yeah. So, don't give up hope. You may find out that he will come back to college later anyway.
And the thing that I wanted to add is...
Or it's not even college. Sometimes trade school. I can't tell you, some of the best paid jobs that we do, because we do tax returns, are electricians, plumbers, all those things that are not very sexy,
Skill.
but
Right.
they're really good trade jobs.
Yeah, no, I know that, and you know that. Unfortunately, they've been sold a bill of goods.
I know,
Yeah.
I know.
And the thing that I wanted to add is the mom and dad, if he went to school for part of the year, they wanted to make sure that they took advantage of the AOTC tax credit, because on the federal, even though you put money into a 529, they can still take privy to the tax credit. They just couldn't do the gain from your 529. There would be no tax credit on the state, but there would be a tax credit on the federal.
So she's
possibly,
saying make sure that the mom and dad took the American Opportunity Tax Credit.
for your grandson.
Okay?
All right, thank you very
Thanks,
much.
Pat. Thanks for
All
calling.
righty.
Have a good day.
Bye-bye.
Bye-bye. I'm Esther Gulius from EG Tax, 8030930, 8030930, star 930 on a cell phone, and we're going to go to Dave in Pendleton. Hey, Dave.
Hey, good afternoon, Esther. Love the show.
Thank you, sir.
I was calling because you're talking about 529 plans, and I have my 10-year-old daughter who have a little bit of money put aside, about $5,000. Would like to maybe move that over to a 529 and anticipate, the college expense. Mm-hmm. But I was just wondering, with only 8 years, which will go pretty quick before she's done with high school and ready for college, is that going to be the best plan to put the money into with the, biggest bang for the buck to grow within 8 years? Because it might be limited what I can contribute monthly to the plan.
Here's the thing. You basically, when you're putting it in the 529, the state of New York is the one who's going to manage it, all right? Because they're the people. So appreciation, I don't know what it's going to do. I don't think anybody knows what it's going to do. The 529 plan only really gives you a deduction on the state of New York, on your New York state return, and any appreciation is going to grow tax-free if it's used for higher education. Now, here's the other thing you got to think of, is when they're looking at financial aid, they see that there's a 529 plan for that child. So that kind of mitigates some of the financial aid that your daughter may qualify for when she's going to college. So you have to kind of put that into your thinking cap as well. So if you're looking at putting $10,000 at 8%, you're saving $800 a year in income tax. But you have to say, gee, if I'm giving up financial aid because she's got this 529 plan, maybe I should put the money into something else. So that's something you want to look at as well.
That's a good point. I didn't even think about that. Perhaps this particular situation, it might be better suited just where it is.
Maybe, because I'll tell you, once it's designated, it affects the financial aid.
Yeah, and I haven't seen outstanding successes with 529s, but
no, that's true. They don't really grow. There's that teeny little deduction on the state of New York.
Yeah.
But so, they are out there. It's a great thing for grandmas and grandpas if you want to give something to your grandchildren. But obviously, if there's money set aside for college, when they're looking at financial aid, that factors in.
Is there thresholds? I am really unfamiliar with financial aid these days in terms of household income is eligible for X amount, or how does that even work, generally speaking?
Are you a married couple? Are you married, Dave?
Yes.
Okay,
Yes.
And so about how much do you guys make a year?
Oh, I would say probably combined, maybe 75.
Okay, if you go to FinAid, there's a website called FINAID.com. It is an absolute wealth of knowledge as to what kind of things that you can do to get the best bang for your buck from financial aid.
Yeah.
I have to tell you, it's a mystery to me exactly how they determine that. And the other thing is, make sure you go to the financial aid office. So because many of the colleges will give you a lot of help if they understand that you can't afford it, because they want your kid to go to college.
Yeah, wherever they decide to go to college, each one of them has a financial aid office, and that's the best place to talk to.
Right.
I'm thinking at your income, Tap and Pell
would be available.
Yeah,
would be available, and especially if it's a first child, they get less financial aid. If two kids are in college, you get more. But take a look at FinAid, because that really is a great website.
I will. Listen, thank you very much.
Hey, thanks, Dave. Bye-bye. Okay, let's see. We're going to go to Dave in Buffalo. Hey, Dave, how can we help you?
Hi, Esther. How are you today?
I am free at last. Thank God Almighty, I'm free at last. What can we help you with?
Okay, Martin Luther. Listen, what happened here, I made a boneheaded mistake. Every year, unfortunately, because my wife, I should have separated myself years ago from the prior spouse, and we've been married for an extended period of time, over 20 years. But every year, because of the fact that I haven't done the separation, I've got to do the injured spouse, innocent spouse supplemental addendum to the federal and state. I forgot to do it on both the federal and the state this year. Now, it worked out in the federal because he doesn't know any money and at all for the federal, but the state garnished that whatever tax, whatever portion of the tax was due coming to me in the state, they reduced that balance by that amount of money. So I submitted an addendum to the file. To the income tax reform for 2004.
For the non-obligated spouse, right.
For the state.
Right. Now, my question to you is, now I did this approximately about a month ago. What is the time frame? Because I keep checking where's my refund, and you're saying your offset was, the amount of refund was due to you was given to an offset. Now, obviously, that's going to be correct. What is the anticipated time frame of them debiting me or crediting me?
You want to know how long it's going to take for them to process the amended return?
I think 3 to 4 months.
Right. It's going to take a long time.
12 weeks. But, yeah, I if I were you, I would call New York State 518-457-5181 and just check on the status in about 3 to 4 weeks. Actually, I call New York State all the time, and they answer in about 4 minutes. So, Dave, if I were you, I would call New York State and check on the status because sometimes they haven't received it, and so sometimes you'll have to send it in again. So,
yeah, did you send it certified, Dave?
No, I didn't send it.
Well, because I'm going to tell you, without proof that you sent it in, you just don't know that they ever got it. If you know what I mean.
I would call New York State.
What's that number again? 518?
Do it again.
518-457-5181. 518-457-5181. It's a short wait. I would call New York State.
Yep. Okay?
Thank you, girls.
Thank you, sir.
And enjoy your freedom.
Thank you. Hallelujah. Bye-bye. I'm Esther Gulius, the tax lady, 8030930. 8030930, star 930 on a cell phone. We're going to take a short break. We'll be back with your calls on the other side. All right, Tyler, I know this is not the Stones. Who is it?
Goo Goo Dolls.
The Goo Goo Dolls.
From
Hey,
Buffalo.
I'm the Goo Goo Esther. I'm Esther Goo Goo. I'm Esther Gulius from EG Tax. And I'll tell you, this time of year, I'll tell you what we're going to do. We're just concentrating on stuff that you need to know to get ready for next year, to make you smarter about your finances. You know, because taxes are the result of what you do with your finances. And we're really all about what to do to make sure that you are a smart person so that you don't shoot yourself in the foot. And so that's what we do all summer long. Not that we don't do taxes, because we certainly do taxes, but we want to make sure that we help you along the way.
I do it for 17 years. People work really hard, and they really, really and so you want to make sure at the end of the day your hard work pays off.
That's right, because, something silly like, somebody that says, I had $50,000 in credit card debt, so I took $50,000 out of my pension plan. And so then you think, oh, my God, there goes $20,000 in taxes, and you think to yourself, oh, my gosh, there was such a better way for them to handle it.
Home equity.
And that's and I'm going to tell you, before you do something like that, just use us as a resource. We'll never, ever say, no, that's not very smart.
Right.
Because ultimately it's your money, but it's really good to run something by somebody so that you know how all this stuff affects you.
Sometimes you can call your parents and ask if you can borrow some of that money. We're talking about estate planning sometimes.
Well, and sometimes people have the money in the bank and they just don't want to spend it.
Right.
Anyway, I'm Esther Gulius, 8030930, 8030930, star 930 on a cell phone. We're going to go to Mr. Jim. Hey, Jim, how can we help you?
Hey, hello, the tax ladies.
Hey.
I was wondering, I've been a sole proprietorship all my life, and I'm about to being talked into becoming an LLC.
That's a good thing.
And yeah, for liability purposes. But what I don't understand is the difference in terms of taxes.
Actually, there's no change. I mean, you're going
to own property though. I own a lot of property and rental incomes and things, and I just don't quite get a hold of what.
Okay, so what's going to happen is you're still going to do your Schedule E's. All right, but you're a limited liability company. So each one of if this is set up correctly, each one of your houses are a limited liability company on their own. So that, like, let's say somebody breaks their leg at property A, that's the only property that can be sued because that asset stands alone.
And Jim, are you going to be the only owner of the LLC?
Yes.
Yeah, so basically,
I have one, and I have one with a partner. So
yeah,
I have two LLCs.
Yeah, so I mean, in essence, that's what the theory is. That anybody that has an LLC, if each property is held separately in a separate LLC, then you're still going to do your Schedule E's per normal, but each one of those are limited liability companies, and so only the assets for that limited liability company are at risk. So bear in mind that you can be held responsible if you do something illegal, which I know you would never do, but so that would be the only fly in the ointment. But so if property A has net asset value of $80,000 and somebody sues and wins, then at least you're not going to lose all your properties. You just lose that one.
So you think it's a good move?
Yeah.
Is mortgage interest something that I've been told is good to keep so that you can keep deducting that?
All right. So here's
if you own your properties free and clear, that you should keep running a mortgage.
No,
you can use that deduction?
No. Here's the thing. Every dollar you make is multiplied by your tax bracket. If you're in the 15% bracket, you're going to pay 15% of all of the income you make. So if you make $100,000, well, no, let's say $10,000, you'd pay $1,500 in taxes. When you have a liability like interest, you're in the 15% bracket. If you pay $10,000 in mortgage interest, you really save $1,500 in taxes. So you might say, "Wow, that's good. I get to save $1,500." But remember, you paid $10,000 in interest to save $1,500. It is much better financially to not have the debt. Sure, you're going to pay $1,500 more in taxes, but you save $8,500 extra dollars.
Yeah,
so it's better not to have debt.
That's a misnomer.
It's kind of like, if you can't afford it, the good thing is the IRS in state of New York is kicking in part of the tab. But if you can't afford it, don't have the debt because you're much better off financially.
Our repair expenses are those are deductible expenses. Is that a good thing? If you reinvest in your into your
absolutely
properties?
Well, I mean, you have obviously when you're running rental properties, you have to make sure that you are taking care of those properties and maintaining them because of health interests, right? So the benefit is, yes, you get to take those as an expense, but you would never go put in a gold faucet in your rental property for a write-off. You know what I'm saying? You wouldn't say, "Oh, well, I just paid $100,000 for that faucet because I'm going to save $15,000 in taxes." You paid $100,000 to save $15,000. You would never do that. That would be stupid. So obviously, if you have to do it, you're going to get it as a write-off, and that would be good. But you would never go create a debt for the sake of creating a debt.
And of course, anything that's brand new, you have to depreciate over the lifetime, the life expectancy of that asset. If you're putting in a new kitchen counter, you have to depreciate that. Something that repairs or maintains, you can expense all that year.
But you wouldn't create a debt.
Is self-employed health insurance still a 100% deductible?
Yes, if you're self-employed, yes.
As an adjustment
to income.
I get it. Okay.
Okay.
You've taught me a lot. A lot of questions. I really appreciate you, tax lady.
All right. Thank you, sir. Have a good day.
Bye.
Bye-bye. I'm Esther Gulius, the tax lady, 8030930, 8030930, and we're going to go back to the phones and talk to Mike. Hey, Mike. Hello, Mike. Hi.
My question is regarding property damage.
Okay.
Whether I'll be able to write it off on my taxes or not.
Okay.
I did a walk through my yard, and I noticed I had some damage to my pool and to my fence.
Okay.
But I called the insurance guy, and it's not covered by insurance.
Okay.
Now, am I going to be able to write any of these off on my taxes?
All right. So this is your personal home, correct?
And I got to say, the best thing that you did first was calling insurance. That was number one.
But this is your personal home. So in order to have this, you're talking about a casualty loss. In order to have a casualty loss deduction, it has to exceed 10% of your adjusted gross income plus $100. So if your income is $100,000, the casualty has to exceed $10,000 after insurance reimbursement. So if the casualty does not exceed 10% of your adjusted gross income plus $100, then you have no deductible write-off.
Okay. So I wouldn't be able to do it.
It's pretty extensive.
It's pretty. I mean, this is kind of reserved for those catastrophic kind of things like a tornado flattened your house. And they only gave you half insurance, or they stole your car and it wasn't covered by insurance. But pretty much it's tough. It's a tough thing to get, and it's not the best deduction in the world because it really means you lost a lot of money.
Okay. Well, thank you so much.
All right, thank you, sir.
Good question.
Bye-bye. Good question. I'm Esther Gulius, the tax lady from EG Tax. Now, if it were business, then you don't have that threshold to come up to.
Right.
Then if it's a business deduction, you take it as a $47.97, and it's an ordinary deduction. That's why I asked him if it was
I've learned so much from you.
Aw,
yep,
you're
it's
so
true.
sweet.
It's true.
Yes, the old lady just know a lot about taxes because been doing this forever.
So that was why it was the first question you asked Mike. Is this your personal residence?
Because if it wasn't personal, then it would have been deductible.
Right.
So, okay, the other thing we want to talk about is for those people that have trusts that have revocable trust. A revocable trust means that you get to futz around with the money and where it goes, and that really means it just goes on your personal return. So if you think that it's sheltering you from a nursing home expense, you got another thing coming. You really want to make sure that you have an irrevocable trust.
Yep.
So that means that that money belongs to the trust and not to you. So you want to make sure that if you're somebody that's trying to shelter your assets because you're worried about aging and your assets, you want to make sure you put your money in an irrevocable, irrevocable
and you want to ask the right questions. I did a tax return for a couple in their 70s, and their brokers sold all their money to go into their trust, and it flowed over to their personal return, and they didn't know that this was happening.
So mamma mia,
be knowledgeable.
Right, that's true. That is true.
Yeah.
If you have any estate questions, if you're wondering what to do, we're going to have an estate attorney on in one of our summer programs. But the rest of the time, you can just call EG Tax at 632-7886. We'll be very happy to help you. Use us as a resource. Until next week, I'm Esther Gulius, the tax lady. Hallelujah, I'm free until next tax season with Tiffany Fabian. Have a great week. Bye-bye.